Hello everyone and welcome to the Quantpedia Explains Trading Strategies video series. Today, we will discuss inflation and US dollar trading strategies.
Hello, my name is Radovan Vojtko, I'm CEO and Head of Research at Quantpedia. Today we will discuss once again market timing strategy. We will discuss the strategy that's impacted by inflation, and what's the interesting about today's video is that we will discuss currency market timing strategy, which is not a very common combination. There are a lot of the market timing strategies, so market timing strategy is one in which you try to select the good time to enter the market and then use some indicator to exit the market, and you are trying to be out of the market in case it's not favorable. What is unusual is that there are not all the market timing strategies for currency markets. This is very interesting. So what we will discuss is we will try to find out what is the impact of inflation on the performance of the US dollar. If you remember my older videos, a few weeks ago we discussed what's the impact of inflation data on gold and treasury investment. When we analyze the data sets of the treasuries and also the gold, we include in the analysis also the US dollar. The US dollar is not performing so strong as gold or treasuries. It's significantly less volatile, but when we were doing the analysis, we realized that the US dollar also reacts to inflation. So when the inflation is going down, US dollar usually goes up, and when inflation is going up, US dollar usually goes down. Performance is not as strong as in the case of gold or treasuries, but it's still an interesting observation, and we decided that we will take a look into the US dollar and we will dedicate it individual article. So here we are, and we have an article about the impact of inflation on the performance of the US dollar. Firstly, it's good to build like the benchmark strategy. So we were interested to see what is that impact of inflation on US dollar alone. As we saw in the previous analysis, US dollar is sensitive to inflation. So if inflation rises for 2 consecutive months, we should take a short position in US dollar, and we hold it until the opposite signal arrives. And what is the opposite signal? The opposite signal is that inflation declines for 2 consecutive months, and then we take a long position on the US dollar, and once again we hold it until the opposite signal arrives. So here we have the equity curve of the model. This is our benchmark model. The data are from 1981, so we have data for 35 years or so. We can see that the strongest performance is approximately between 1990 and 2005, maybe 2010. So the results in the last few years are mixed. There is definitely room for improvement. So the basic strategy has around 1.5% performance, Sharpe ratio around 0.2, small volatility, maximum drawdown 35%. What is the added value of the US dollar or currency strategies is that we can easily leverage them. So even the small performance, if we have interesting Sharpe ratio of the strategy and we have a small performance, we still can use the leverage and we can easily leverage the strategy and have like higher performance, or the performance which is comparable to bonds or equities. Okay, so for the first idea how to improve this basic strategy was to find out what is the impact of the Fed or Fed rate. Naturally, Federal Exchange has some say regarding inflation, of course. So we formed our second rule, and the second rule is that we defined that we are in the Fed up period, so in the period when the Fed hikes the rates after the first rate hike. So once the Fed or Federal Reserve changes stance on the inflation and starts to raise the rates, we switch into the Fed up period, and the Fed down period is after the first cut by the Federal Reserve. So we switch once the Fed starts to cut rates, and this Fed down period ends when the Fed starts to raise rates once again, or hike rates. So what does it mean is that if we combine the impact of the Fed and if we combine the inflation, we in total have 4 different market periods or epochs, and the 4 graphs which are below, they show how the performance of the dollar look like in the combination. So what does it mean is that we use 2 different ETFs as an investment vehicles. One ETF is for the short US dollar position, it's the UDN ETF, and another one is for the long US dollar position, it's UUP, Invesco DB US dollar index bullish fund. So firstly we can take a look what is the equity curve when the inflation is going up and the Fed is raising the rates. There is like no significant trend. Now here we have when the inflation goes up and the Fed cuts the rates. Here we can see that US dollar significantly underperforms, so we can buy US dollar UDN ETF and we can get some performance out of that. When the inflation goes down and Fed rises the rates, there is like no observable trend, and once again when inflation goes down and Fed decreases the yield, we can in this moment buy the US dollar. So what does it mean? We can see that it's really advantageous to go long US dollar if inflation goes down and the Fed cuts the rates. And secondly, it's a good idea to short US dollar if inflation rises and the Fed cuts the rates also. This cutting of the rates is probably, the error on the central bank policy. So it's not a good idea to cut the rates when the inflation rises. And that's the reason why the US dollar goes down. But what does it mean is that we can short the US dollar and we can earn some money. We can integrate those two rules into the mixed strategy and we have the following performance. So what we can see is that performance is significantly better at this moment. So we improve the performance of the model compared to the first one, just the knife model based on the inflation. We have the lower volatility, better Sharpe ratio, better maximum drawdown and better Kalmar ratio, which is the performance compared to the maximum drawdown. Clearly, when we integrate the Fed policy and inflation signal into one strategy, we outperform the basic benchmark strategy. The Fed policy or Fed standing is not the only signal we can use. We can use just the 3-month rate itself. So instead of using the Fed rate, we can use the 3-month treasury rate, which is implied yield based on the short-term treasury. So what is the market expecting the short-term rate treasuries to earn? And we can base our signal on that, and we can use the same logic as for inflation. So if the 3-month rates rise for 2 consecutive months, we are in the rates up period, and alternatively, if the 3-month rates decreases for 2 consecutive months, we are in the rates down period. And once again, we can mix that signal from the 3-month rate with the inflation. And here we have a chart with all of the individual sub periods. Once again, we can see that when inflation goes up and rates go down, it's the best to short the US dollar. And once again, when the inflation goes down and rates go down, it's better to hold US dollar. So it's very similar to the previous model. But what is the advantages is that we have a little better Sharpe ratio. We have a little smaller performance than the model number 2, but the better volatility. The maximum drawdown is plus or minus the same, and the Kalmar ratio is plus or minus the same. Model number 2 and model number 3, so using the Fed or using the 3-month rate, are very, very similar. But what we can do is that we can combine those two models together, and we can probably have a more robust strategy because our signal generation will be diversified. We do not plan to explore this possibility at this moment, but if you would like to use this inflation plus rates or yield signals, we will probably mix them together. So we will use the Fed rate and we will also use the 3-month rate, and we will mix them together because the resultant strategy is in this case usually more robust than just using one signal. But there is another signal that we can use, and it's the impact of interest rate differentials. So the US dollar currency is not alone in our world. So the absolute measure of the US economy or the absolute measure of the level of interest rates is not the most important driver for the performance of the US dollar. But what is important is also the relative standing and relative measures. So one of the most important measures is the interest rate differential between the risk-free rate in the US dollar and the other currencies. And it's sometimes called the carry yield. That's the yield that you can get by holding the US dollar and shorting other currencies, or another case, holding the other currencies and shorting the US dollar. So how we can calculate the carry yield? So we can take the difference between US 3-month rate and the average of the 3-month rates of the other 6 major currencies, which is euro, Canadian dollar, Swiss franc, British pound, Austrian dollar, and Japanese yen. And we can use that difference or the spread between US 3-month rate and the average of those 6 currencies rates as our predictor. And firstly, we can define simple US dollar carry trade strategy or benchmark strategy. So what we do is we go long US dollar if it has a higher rate than the average of the other currencies or other countries, and we short in the opposite case. So when the US dollar has a lower rate, we short the US dollar and we go long the other currencies. As we can see, this carry strategy has a nice performance approximately until 2010 plus or minus, or 2008-10. Afterward, it doesn't have such a good performance. The reason for that is because after 2008, there was a strong trend to have a low interest rate all around the world. So it was a period of financial repression, and during that period of financial repression, the carry strategy doesn't perform very well. This changed in approximately 2020 when the inflation returned, and from 2020 we once again have a trend in the strategy that goes up. So we can probably expect that, in the next 5 to 10 years, the carry strategy will perform once again well, and it can perform as well as in 90s or 2000. So this is the performance of the basic carry strategy. So we have approximately 4% return, 8% volatility, Sharpe ratio around 0.5. Once again, we can combine this carry strategy with the inflation signal, and this is how does it look like. So when the carry shows that we should buy the dollar, so the carry is up, and the inflation is going up, it is good to have a, long dollar position. When the inflation is going up and the US dollar has a lower interest rate than all of the other currencies, it's better to short the US dollar, which is like, you can expect that. When inflation is going down and the carry is up, so it means US dollar has a higher interest rate, we should hold the US dollar. And in case when inflation goes down and the US dollar has a lower yield than all of the other currencies, the results are mixed. So what the previous figures shows us that it's best when we go long US dollar if it has higher rates than the rest of the world, and doesn't matter what's the inflation. If the US dollar has a higher rate, go long the US dollar. And we should short the US dollar when the inflation accelerates and the US dollar has lower rates than the rest of the world. In this case, we have this combined strategy. Once again, the strategy performs relatively well until 2010. Then it has the mixed results due to probably financial repression era between 2008 and 2018. But after 2018, it has like okay performance. In total, we have a little lower total performance of strategy, but smaller volatility, better Sharpe ratio, better maximal drawdown, better Kalmar ratio, which is performance compared to the maximum drawdown. What is the conclusion of all of those findings? So firstly, we can see that inflation has an impact on the performance of the US dollar. You can combine information about the inflation and monetary policy actions into one strategy. So we showed like 3 different versions of the strategies. There is not one that's our favorite. In case we would like to build a strategy that uses those macroeconomic signals like interest rates and inflation, we will probably combine all of those signals together. It's better to have like diversified signal generation, and then you have a more robust strategy. Of course, the era of the financial repression like 2008 down to 2018 is hard for these strategies. Interest rate spreads between all of the currencies were low. There was not a lot of the movement in the US dollar compared to the other currencies. But after 2018, most of the models are performing plus or minus well, and we can expect that volatility will return, or volatility is back in financial markets, especially in currencies. We will see, or we will check how these strategies perform in the next few years. But I believe that as the inflation returned and we have higher interest rates between different currencies, we will probably see return of the performance into these macroeconomic strategies. So if you are looking for interesting strategies to add into your portfolio, I would recommend those macro strategies. They are a good diversifier and they are not price based, so it means they correlate well to other price-based strategies that are using the currencies. Thank you very much. I hope that you liked this video. Please give us a like, subscribe to our channel, visit our social media channels, visit Quantpedia and Digital blog, and I hope that you will join me in the next video.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.